Divi's Labs climbs nearly 6% on a strong fourth quarter performance where the margins are at a multi-quarter high. Profits grow 23%. The management in the conference call say the company is eyeing double-digit revenue growth in FY26.
Delhivery zooms nearly 10% following a good operational performance in the fourth quarter. The company has reported a profit in comparison to a loss in the corresponding quarter last year.
Protean e-government tanks 20% after it informs the exchanges that it has been not considered for the next round of selection process for the PAN 2.0 project by the Income Tax Department.
Graphite India and HEG climb after major Japanese graphite electrode manufacturer Resonec halts production in China as well as Malaysia. The street believes that this will create some kind of a supply shortage globally, which could push up prices.
Credit Access slips more than 5% on the back of its fourth quarter numbers. Dispersals come down nearly 20% year-on-year. Net profit declines 88% from a year ago.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, the headline index is as flat as can be on this Monday morning. However, the broader markets is still showing some strength. And that's why you have the number of stocks advancing to the number of stocks declining. Well, that ratio is 2:1. So pretty good looking screen, Mangalam.
Pretty good looking screen, Nigel. You know, we've seen that happen on Friday as well. After a big surge that we saw on Thursday, that day, the frontline indices moved, not so much the broader markets. Now, perhaps the street believes that it's time for the frontline indices to consolidate around that 25,000 mark for the Nifty and around that 55,000 to 56,000 zone for the Nifty Bank. Whereas the broader markets, which had been underperforming versus the last time the Nifty hit that 25,000 mark, has some room for up move, and that exactly is taking place. Let's get in Vinay Rajani of HDFC Securities for a quick technical check on the market. Vinay, your thoughts on where the index is headed, but more importantly, individual stocks. What are your calls there?
Good morning and thanks for having me on the show. So index is into a clear-cut uptrend for last two trading sessions. As you said, it has been into consolidation of 100 points. But if you were to look at the broader markets, they are doing excellently and the returns have been generated and the kind of momentum we can see in the broader market is quite good. So overall trend is very strong and 24,500 becomes a very strong support zone. And in any case, if we see any intraday correction or correction in a running correction for next 2-3 sessions, 24,500 should be the stop loss in trading long position. And immediate resistance we see is around 25,200, which happens to be the 76.4% retracement of the entire fall which we saw from the all-time high. So 25,200 is the immediate resistance, and above that we can expect Nifty to hit an all-time high. So overall view is bullish. Broader markets are very strong and one should continue to participate. Sector rotation is going on nicely. So it is a good market. I think if index remains like this into consolidation, it would be better days for the mid cap and small cap. So one should try to capture the broader markets rally right now. And as far as stocks are concerned, we are basically bullish on the PSU bank. So IDBI Bank has given a fresh breakout. So it is trading around 90. So if somebody is looking for the trading, one can go along with a stop loss of 88. On the higher side, we are expecting a target of 95. This is for the short term. The another space which we like is the real estate space, which is DLF. So DLF is the large cap real estate stock which is doing good. So 730 is the price around which one can go long. 715 should be the stop loss, and on the higher side we can expect a target of 755.
Okay, all right. Thanks a lot, Vinay, for joining in, giving us your take on the markets as well as your individual stocks. For the time being, we slip into a short break. On the other side, we have the management of KRBL that will be joining in to detail their past quarter's numbers as well as the way ahead.
Welcome back. Let's talk about KRBL. The company is on our radar on the back of their fourth quarter numbers. We have the management joining in. They've seen a profit growth year on year, and we have the exports that grew a lot more. Ashish Jain, who's the CFO, joins in to discuss these numbers. Thanks a lot, Ashish, for joining in. Always a pleasure speaking with you. Let's talk about the exports part of your business. The fourth quarter, they contributed about a third of your overall revenues. They've seen an increase. I'm not sure how much of that is on account of increase in realizations and how much of that is on account of your own, product mix doing a lot better there. On that account itself, if you could give us a sense on what the FY26 looks like for you, for both domestic and exports in particular, and what kind of prognosis that you have when it comes to growth.
Thank you, and happy to be here. As far as exports is concerned, our Q4 really had two underlying trends. One is in terms of our key markets for branded exports, as we mentioned earlier, we were facing some distribution challenges. We had mentioned that we will use the last financial year to address those. So I think that process has begun. And what you are seeing on the branded side is an outcome of that, where our volumes in some of the key markets have picked up. The second side of the export business is the private label business. Now, that was slow for us in FY24. We had again mentioned at the beginning of FY25 that that's going to fare better. So that's also stepped up. So both these things combined have led to the growth. As far as the domestic business is concerned, our volume growth on the branded basmati side is in line with what the category growth is during the year. However, over the last 1 year, we've seen, impact on the rice prices. Broadly speaking, rice prices have been down about 20 to 25% year on year. And as we compete with the loose and the unorganized sector, that's impacted our realizations as well. So on domestic side, while the volume is in line with category growth, it's really the realization impact coming through, leading to a low single-digit growth.
All right.
As far as FY26 is concerned, we see the trend on exports continuing and in fact strengthening. On the domestic side, our current view is that the prices have settled down. So the realization, which was the key factor for the business in FY25, should help us to enable better growth next year.
All right. Hi, Mr. Jain. Good to see you, Ben. Nigel on this side. So good to hear that you expect realizations to move up from here on. Give us a few more details, though. Saudi as a percentage of your business, how big is it? And also, I think the distribution challenges were in Saudi, right, which you were looking to iron out in the next 3 to 4, in the next few quarters. Could you clarify on that?
So we don't give out country level details, but Saudi is a top export destination for basmati from India, and so is it for us. In terms of our performance in this market, I think we are still doing a fraction of the volumes that we did earlier, but it's been picking up. Sorry, what was the second question, Nigel?
The distribution, there were some distribution challenges even in Saudi, right?
That's right. So that was the main market where we had distribution challenges, and we've been able to address those. At least the process has started.
All right. And in the next couple of quarters, you're hoping to iron out things?
Yes.
So how long before you go back to historical volumes in Saudi?
See, it's a consumer-based business. So, in terms of getting back to earlier levels, it's difficult to predict a timeline. But what I can say at this point is that the process has started.
Okay. All right. What about your market share? If you could tell us, what is your market share in general trade, modern trade, as well as e-commerce? What is it currently, according to your analysis? And do you see scope for you to go ahead and grab a higher market share?
Yeah. So, if you look at the domestic market, which I guess is what you're referring to,
Yes.
FY25, I think we've recorded gains across the channels, and we've reported exact market shares in our investor deck. But across channels, we've been reporting gains. And I think we are fairly positive that we'll continue to build on that in the current year as well.
When we speak about your business, it's largely rice, but over the last few years, you've been moving into non-rice as well. You had a target of 10% revenue coming in from non-rice products or value-added products as well, as it were. Where does that number stand at? What is the growth here likely to be?
Yeah, so I think you're right. What we'd mentioned is that over the next, I would say broadly 3 to 4 years, we wanted that number to be around 10% of our overall revenue. I think we're headed in the right direction, although the number currently is small. So we've taken a couple of steps. One is that we have, for the last 2 years, we've been focusing on the non-basmati market. We believe that that's a very large opportunity in India. We did about 220 odd crores in FY24. The FY25, we did about 190 crores in that business. We are recalibrating that business, for focusing on the varieties that offer large potential along with margins. So that is underway right now. Q3, Q4 is when we've kind of recalibrated it. So you should see that business growing back. In terms of other areas that we're focusing on, recently we got into healthy edible oil segment. We believe that both our brand as well as the supply chain that we have lends itself very well to the healthy oil opportunity, and that kind of fits in with our portfolio. So I think we are in line in terms of what we committed earlier in terms of non-rice revenue.
6,000 crores by FY26 in terms of a revenue, above 6,000 crores, is that possible? And exports contributing what, 1,800 crores over what, 1,350 crores that you did last year, is that possible?
That's what we are aspiring for right now.
All right, and margins?
Should be an improvement over the current year.
By how much?
We don't give out guidance, but I think a Q4 is a good indicator.
And I think you said that realizations have improved. As on date, what is the realization, uptake that you've seen, say, today in comparison to the average you've seen the last couple of quarters? How much higher is it?
Yeah, Nigel, I would just clarify. So I think what we are seeing is that the realizations are finally stabilized. Against year-on-year drops, in fact, continuing till the early months of Q4, we are now seeing that they've stabilized, and our view right now is that they should remain at this level for the rest of the year.
Okay, all right. Stabilize, then revive, and then thrive. I guess that should be the way you're looking at it. Thanks a lot, Mr. Jain, for joining in and filling us in with all of those details. Wishing you all the best for the remainder of this year. But for the time being, the street likes your Q4 numbers as well as the outlook ahead. Stock up close to around 5%. Well, time to slip into a short break. As we do that, though, there is some good news coming across for all our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, as well as financial world updates. All of this at your fingertips. Download the CNBC-TV18 app from the Apple Store or from the Google Play Store, or just scan this QR code that's up for you on the screen.
Welcome back. A bunch of stocks doing extremely well. We have Jubilant FoodWorks up around 2% from the lows, currently at the high point of trade. We're seeing some traction in Strides Pharma as well. Astral is the other one, which is up around 5%. That's the broader markets. You know, the frontline indices are consolidating. We do have a bunch of stocks which are spiking. Even in the cash market space, we have Yatra Online, which is up 6%. We have Office Solutions, which is up around 4.5%. And we are seeing some traction in names like Rallis India, which continues to buzz with a gain of 4%, having put behind it a good month so far. In the month of May itself, Rallis India, after a good set of numbers, has rallied about 28%. That's in the month of May so far, and currently moving up to the high point of trade as well. But what's really done well over the last couple of weeks have been the defense stocks. Data Patterns and Zen Technologies are in focus after reporting their fourth quarter numbers. Ria joins in to tell us more about that, but more importantly, the outlook for these companies. Ria.
Well, yes, both Data Patterns and Zen Technologies have both been in focus once again today after reporting a very healthy set of numbers on Saturday. For Data Patterns, the revenue has gone up by around 117% on a year-on-year basis. EBITDA and net profit have both jumped up by around 61% over the previous year. Margins, however, have contracted to about 38% in this quarter versus 51% that we saw in Q4 of last year. For FY25, they've surpassed their revenue growth guidance of 20 to 25%, and they've also surpassed their EBITDA margin guidance of 30 to 35%. The order book, however, that has been weak for the company, coming in at just about 730 crores in this year versus 1,083 crores that we saw at the end of FY24. The order inflow guidance has also been missed. They had a guidance of rupees 7 to 800 crores for FY25, but the order inflows have only been about rupees 355 crores in this year. Going ahead, they do expect a revenue growth rate of 20 to 25% and EBITDA margins to be in the range of 35 to 40% for FY26. And today, the company said to us in an interaction that the order intake, although that has been weak in FY25, but that is expected to pick up going ahead. And they also expect an order book of rupees 1,000 crores in FY26. The stock was trading higher, up about 8% in early trade, but has pared some gains post that. Moving on to Zen Technologies, this stock has been in an upper circuit of 5% for the 7th consecutive session today. Revenue has gone up by around 130%. EBITDA is also up by 174% over the previous year. Margins have also expanded expanded to 42.5% versus 35.6% that we saw in Q4 of last year. The total order book for the company is healthy at rupees 691 odd crores. For FY25, they surpassed their guidance on all fronts for revenue, EBITDA margins and PAT margins as well. Going forward, they do expect to execute an order from the Ministry of Defence for integrated air defence combat simulators for the L-70 gun in FY26 itself. And today, the company also told us that operating cash flows are expected to turn positive in FY26. They're also expecting a revenue growth CAGR of 50% over FY26 to 28, and they're expecting cumulative revenues of rupees 6,000 crores over the next 3 years. So overall, very positive updates for both of these stocks, trading higher in today's session.
Thanks a lot for that, Ria. Well, let's focus on our graphite electrode companies. And Graphite India and HEG, they are buzzing in trade. The key reason is over the weekend, Resonac, that's formerly known as Shobha Denko, they have halted graphite electrode production in two of their geographies, that is in China as well as in Malaysia. Now, the reason they have cited is that the business is facing margin pressures. This is very, very important for the global graphite electrode industry. Why is that? Because Resonac has approximately 210,000 tons of capacity. That equates to close to around 30% global market share, that's ex of China. And reports are suggesting that China as well as the Malaysia shutdown can impact a third of Resonac's capacity. So basically, the street believes that Resonac's shutdown will result in lower supply in the global markets. That in turn can boost graphite electrode prices as well as profitability. Just to give you a rough number, 210,000 will be around 30% of the global market share. If a third of that is going to get impacted, will be roughly around 60,000 tons, which, if you take it on a global basis, it should be closer around 3.5%. That's including China as well. It could be, back of the envelope calculation suggests, it could be roughly around 3.5% of global capacity, which in turn is pushing these stocks up. They've got badly beaten down because of pricing. Now it seems they've got a bit of a tailwind in store. So both these two buzzing in trade.
Take that point, Nigel. Thanks a lot for that. So that's about Graphite and HEG. Just keep an eye out on Delhivery. That continues to do well. In fact, right from the word go, the stock was higher. And today, currently at the high point of trade as well. And after a spate of underperformance, the stock has reported good numbers. At least the street is believing that, the operating leverage in their part truckload business is playing out. Part truckload business basically is where, you don't have enough stuff to fill the entire truck. So the companies, book part trucks from a lot of various companies. And that actually is more margin accretive than the other businesses for Delhivery. So in part truckload business, the revenues grew by 24%, volumes grew by 19%, and margins jumped from 3.2% all the way up to 10.8%. And that's reflected in their overall numbers as well, where the revenues, which grew just about 5%, had actually seen an EBITDA growth of over 150%, 119 crores, as against 45 crores. And the bottom line was further boosted by their change in depreciation method. About 3 quarters ago, they changed their depreciation method, by which, there has been a savings of 60 crores on the recognized depreciation out there. And that has further boosted their bottom line. E-commerce, which accounts for most of their revenues, is actually soft this time around. So volumes have grown by just 1%, revenue growing by just 3%, tells you the weakness in the channel itself. Quick commerce is growing, e-commerce not so much, and out there margins have compressed too. But here, the trigger is scaling up of the acquisition that they've made of Ecom Express. So that will play out for Delhivery, and that's something we'll watch out for. In terms of cash, they have about 5,500 crores on their books, so no real worries out there. The only fly in the ointment with Delhivery is that with every subsequent rise, the risk of supply increases because the shareholders, a large amount of big institutions holding Delhivery, waiting to offload. So any good news in Delhivery typically is bad news when it comes to the supply of the stock situation. But that's for another day. Today, the stock rejoicing on these numbers.
Okay, all right. Thanks a lot for that, Mangalam. Well, I think on that note, we can slip into a short break, or I think we've got another stock. Ekta is joining in to tell us about a pharma company that she's tracking in today's trading session. Ekta, tell us more about Divi's Laboratory.
Well, yes, Divi's Labs are a good set of numbers, and it's reflecting really in terms of the stock performance. So the revenue growth was around 12% this quarter. It was in line with estimates. We had the margins, which came in at around 34.3%, and that was versus estimates of around 32% and profits of over 660 odd crores, much better than what the street was anticipating. What really stood out this quarter was the performance operationally, where the margins came in at a multi-quarter high. It's the best since Q2 of FY23. Now, in terms of a couple of key takeaways from the conference call, they have indicated in terms of guidance that they would look at double-digit growth going forward for FY26 as well. They are seeing more requests for proposals and quotes to come through because of the Biosecure Act as well as China Plus One. Interestingly, they are not going to be working in terms of generics when it comes to GLP-1. So semaglutide is not an opportunity that Divi's would be a part of, but they would be working with innovator companies when it comes to GLP-1. Cash on books remains high, 3,600 crores plus. Now, in terms of valuations, that's probably the only dampener because it's trading at over 60 times FY26 and over 50 times FY27. Now, a lot of the brokerages were quite positive in terms of the numbers. Jefferies maintains their hold. They say Q4 is largely in line with the balanced growth. They maintain a hold, however, on near-term patent challenges and high valuation. Goldman is neutral. They've raised their FY25-28 estimated EPS by up to 5% to factor in Q4. And Morgan Stanley, overweight with a target price of 7,225. They think the oral GLP-1 intermediate opportunity could be $100 to $175 million per year upon commercialization.
Right, Ekta, thanks a lot for that. That's about Divi's Labs. Let's go across to Sudarshan as well. Sudarshan has an update on Hyundai. Sudarshan, results were slightly better than street expectations, as was the management commentary.
That's correct. So earnings were slightly better than expectations, but the outlook given in the analyst call is looking largely, I would say, majorly positive. On the domestic growth, companies saying that it will grow in line with the industry, but export growth is going to be better. And here growth range is seen in the range of 7 to 8%. Also, companies said it will like to maintain EBITDA margin in double digits. Also, by FY30, companies looking to launch 26 products, and out of them, 6 will be EVs. Most of the brokerages remain positive on the stock. CLSA has outperform call and target is 2155 per share. It believes that company is going to gain market share in FY27. JP Morgan too has an overweight call and here target is 2060 per share. It believes that domestic outlook is muted while export outlook given by the company is better. Nomura has a buy call and target is 2291 per share. It has raised FY27 target multiple to 25 times from 23 times, and Macquarie 2 has an outperform call and target is 2100 per share. So overall, all the brokerages are positive on the stock after company has given the positive outlook for FY26.
Okay, all right, sir. Thanks a lot for giving us that update. For the time being, we'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.